Hello there! Before we begin, we do need to clarify that the information provided in this video is for educational purposes only and should not be considered as financial advice. Now welcome back to our channel where we aim to simplify investing for you. Today, we're delving into the intriguing world of dollar cost averaging. This is a strategy many successful investors employ to maximize their gains and minimize risks. Whether you're a seasoned investor or a beginner dipping your toes into the investment realm, this video is surely for you. And if you're new here, remember to subscribe and hit that notification bell so you never miss out on our invaluable content. Let's jump right in. Did you know 55% of Americans are invested in the stock market, yet many are unsure how to effectively manage their investments? Understanding strategies like dollar cost averaging could be a game changer. So let's demystify one of the most effective strategies, dollar cost averaging. Imagine being a superhero, where your power is not being affected by the highs and lows of the stock market. That's what dollar cost averaging can do for your investments. Picture this. You're an investment superhero. Your superpower? The ability to brave the stormy seas of the stock market with poise and confidence. This isn't a flight of fancy. This power, friends, is called dollar cost averaging. Dollar cost averaging is like your trusty shield. It's an investment strategy where you consistently invest a fixed amount at regular intervals, irrespective of the stock market's current mood. This approach allows you to buy more shares when prices are low and fewer shares when prices are high. It's like having a superpower that reduces the impact of market volatility. Over time, this strategy can lead to a lower average purchase price, potentially increasing your returns. So, how do you wield this superpower? Here's a step-by-step guide. Before you soar into the investment sky, you need a destination. That's your investment goal. Imagine you're a pilot preparing for a flight. You wouldn't just hop in the cockpit and take off without knowing where you're heading, right? In the same way, before you dive into the investment waters, it's critical to set clear and realistic goals. These goals are your financial destination. Perhaps you're saving for retirement, a down payment on a house, or maybe a rainy day fund. Whatever it is, knowing your objectives helps you determine how much money to allocate to your investments and your investment horizon. It's like setting the coordinates for your flight. Without these coordinates, you may end up flying in circles, wasting fuel and time. So, take some time to reflect on what you want to achieve with your investments. Your goals will be the guiding star, leading you through the vast investment universe. With your goals set, it's time to choose your vehicle. Choosing an investment account is like selecting the right airplane for your journey. Just like airplanes, investment accounts come in different shapes and sizes, each designed to take you on a specific type of financial journey. For instance, a brokerage account might be your versatile jet, ideal for most types of investments. It offers flexibility and ease, but be aware, it doesn't provide any tax advantages. Imagine a retirement account, like an individual retirement account or a 401(k) as your long-haul carrier. The journey is longer, but the advantage? These accounts offer tax benefits that can help your investments grow over time. However, they do come with restrictions on when you can withdraw your money without penalties. Whether you're looking for the flexibility of a jet or the endurance of a long-haul carrier, it's important to select the right vehicle. Now that you've chosen your vehicle, it's time to decide on your route. Choosing your investments is like charting your flight path. Each investment is a waypoint on your journey to financial security. And just as a flight path is rarely a straight line, your investment portfolio shouldn't be a single asset. This is where the concept of diversification comes into play. Think of it as spreading your wings across different investment skies. Stocks, bonds, exchange-traded funds. Each of these assets carries a different degree of risk and potential return. Just as a pilot would avoid turbulent skies, you should choose investments that align with your risk tolerance. If the thought of a bumpy flight makes you queasy, you might lean toward more stable, lower-risk investments. On the other hand, if you're an adrenaline junkie, higher-risk investments might be your speed. But remember, this journey isn't a short hop, it's a long-haul flight. So consider investments that align with your long-term financial goals. With your route set, it's time to decide on your flight schedule. Your investment frequency is like your flight schedule. Just as a frequent flyer sets a routine for their travels, an investor needs to determine how often they're going to invest. This is where the beauty of dollar cost averaging, or DCA, comes into play. Imagine each investment as a flight and you're the pilot. Regardless of the weather, or in our case, market conditions, you stick to your predetermined schedule. Whether it's monthly, quarterly, or any other interval that suits your financial situation, the key is consistency. Why is this important? Well, by investing at regular intervals, you're spreading out your investment over time. This helps to mitigate the risks of market volatility. You buy more shares when prices are low and fewer when prices are high. Over time, this can potentially lead to a lower average purchase price, smoothing out the ups and downs of the market. Now, let's talk about fueling your journey. Your investment amount is like the fuel for your journey. Just as you wouldn't embark on a cross-country road trip without ensuring you have enough fuel, you wouldn't want to start investing without deciding on a sustainable amount to invest at regular intervals. This is the essence of dollar-cost averaging. It's not about investing a large sum all at once, but about consistently fueling your investment journey with an amount you can comfortably afford. Whether it's the price of a daily cup of coffee or a monthly gym membership, choosing an amount that doesn't put a strain on your finances is crucial. This consistency, like a well-fueled engine, keeps your investment vehicle moving forward, navigating the peaks and troughs of the market. With everything set, it's time for takeoff. Automating your investments is like setting your plane on autopilot. By scheduling automatic contributions from your bank to your investment account, you eliminate guesswork and the temptation to time the market. This approach not only ensures consistency, but also frees you from the need to constantly monitor prices, reducing stress. It's a set-and-forget strategy that works in your favor, allowing your investments to thrive over time. Now sit back, relax, and watch your investments grow. Even on autopilot, it's essential to keep an eye on the controls. Dollar-cost averaging is an excellent strategy, but it's not a set-it-and-forget-it game. Regular reviews are key to ensure your strategy aligns with your goals. Market conditions change, as do personal circumstances. Adjustments may be necessary to keep your portfolio balanced and aligned with your risk tolerance and objectives. Remember, investing is a journey, not a destination. Enjoy the ride.